Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough. This is for Kiso, Weingant, and Warfield. This is exercise 19.6. So this is from the Intermediate Accounting 17th edition. Textbook authors are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, let's take a look at this exercise 19.6. This can be a little bit different, kind of like a nice little break. So over here, for each item below, indicate whether it involves a temporary difference that will result in future deductible amounts, and this will give rise to a deferred income tax asset. A temporary difference that will result in future taxable amounts and therefore will give rise to a deferred income tax liability, or lastly, a permanent difference. Okay. And how many do we have here? Okay, all right, perfect. All right, so as we look at this over here, when we're using makers, okay, and makers is modified accelerated cost recovery system. So the makers depreciation system is used for tax, and straight line is used for financial reporting purposes, right? So if we're using makers, we're going to take more depreciation earlier. So we're going to be taking more from our tax return. So this is going to be a temporary difference that is going to result in future taxable amounts and is going to therefore result in a deferred tax liability. So that's what we'll just call as DTL. Okay, there you go. All right, deferred tax liability, again, depreciation. A landlord collects some rents in advance. Rents received are taxable in the period when they are received. So over here, this is prepaid rent. For financial statement purposes, I would calling it prepaid rent. It does not go onto the income statement, but for tax purposes, this is going to be hitting our income. So this is going to be a temporary difference that's going to result in future deductible amounts, or basically income that will not be taxed. So this is going to be a deferred tax asset. Okay. Now this one right here is expenses incurred that are expenses that are incurred that are in obtaining tax exempt income. So I'm going to guess this would be a permanent difference, but my guess was correct, because if you're getting expenses for tax exempt income, then those expenses should not be those expenses will not be deductible for tax purposes. So this is going to be a permanent difference. Okay, costs of guarantees and warranties are estimated and accrued for financial reporting purposes. Okay, so a warranty cost. So I'm going to be showing an expense that is probably not going to be recognized by financial statement for basically for income tax purposes, because it hasn't happened yet. So I'm not going to get the deduction on my return. So I'm going to say this one over here is going to be 1, which is going to be a deferred tax asset. Okay, so this is one of those things where if I have a warranty, so if I'm taking warranty expense and I'm crediting warranty liability, I'm taking the expense of my financial statement purposes, but for tax purposes, they're going to say, that hasn't happened yet, so you can't deduct it. So that's going to increase my income because this is going to be added back. This is going to result in a deferred tax asset. Letter E, installment sales of investments are accounted for by the accrual method for financial reporting purposes and the installment method for tax purposes. Okay. Let's think this one through. Okay. So, you know what? The book solution says it's a deferred tax liability, so we're just going to go with that. There's probably a reasoning behind it, but over here, installment sales of investments are, I would want to actually see numbers go through and flesh it out. So we'll just go to the next one. For some assets, straight line is used for both financial and tax, but the asset's lives are shorter for tax purposes. If my asset lives are shorter, that's going to generate more depreciation expense earlier on. This is going to be a deferred tax liability. Okay. Letter G, interest is received on an investment in tax-exempt municipal obligations. This is going to be a permanent difference, right? So again, if it's a municipal bond, it's going to be exempt from tax. I'm going to show the income on my financial statements, but for tax purposes, I don't show it. Okay, so let's take a look at the next one. Proceeds are received from the life insurance company because of the death of a key officer. The company carries a policy on the key officers. These proceeds are going to be exempt basically from taxation. This is going to be a permanent difference. Letter I, the tax return reports a deduction for 80% of the dividends received from U.S. corporations. The cost method is used in accounting for the related investments for financial reporting purposes. This is something that's called a dividends received deduction, and this is going to be a permanent difference. Now, when over here, there's an explanation when the cost method is used for financial reporting purposes, the dividends are recognized in the income statement in the period they are received, which is the same period they must be reported on the tax return. However, depending on the level of ownership by the investor, 70 or 80% of the dividends received from another U.S. corporation may be excluded from taxation because of a dividends received deduction. These tax-exempt dividends create a permanent difference. So that's what it is behind that one. Okay, estimated losses on pending lawsuits and claims are accrued for the books. These losses are tax deductible in the periods in which the related liabilities are settled. So I'm recognizing the expense, but the tax people are saying, we actually want to see the payout. This is going to result in a deferred tax asset. Expenses on stock options are accrued for in the financial reporting purposes. So yeah, those are not going to be deductible. So this is going to be a deferred tax asset. Okay, so that's over if it's even that. So that's exercise 19.6. Hopefully you found that helpful. I'm sorry I don't know all the answers to everything, but I'm sure you'll leave me comments and tell me how to solve these problems. In any event, I want to thank Wiley for allowing me to share and use these videos or use their questions for these videos. Please don't forget to like and subscribe. It really helps. If you'd like to see other solutions, please feel free to ask for them in the comments. Have a great day.